So we'll start with reading number 47 of the CFA Level 1 curriculum that talks about security market indices. So we've heard of many indices, the S&P 500, the Nifty 50, the CNX 500 in India. So what is a security market index? Now, essentially, any index is basically a collection of stocks. So it's some securities or some stocks. For example, an equity market index would be a collection of stocks weighted in a particular manner. So Nifty 50, for instance, is a combination of 50 stocks, the prices of whom are combined in some manner to bring out one value for the index. Similarly, the S&P 500 would be a combination of 500 stocks whose prices are combined in some manner or weighted in some manner to get to one value of the index. Now, the basic purpose of any index is to give the representative performance of an asset class. If it's an asset class based index, for example, a broad equity index or a broad fixed income index, then the index represents the broad performance of the equities or of that particular asset class. It can be used to represent the performance of the market or a segment of the market if it's a specific index or a sectoral index consisting of securities of a particular sector. So there are two essential questions that need to be answered in the construction of an index. First, what will be the constituent securities? So in the Nifty 50, there will be some 50 securities. To be more precise, Nifty 50, generally speaking, has 50 of the largest listed companies in India. So there are these 50 large liquid Indian companies that are part of the index. These are the constituent securities. And then there is a weighting mechanism, that is, in some manner the prices of these 50 securities are combined together to bring one value of the index. So we'll study in detail. In case of the Nifty 50, the weighting mechanism is a free float market cap. We'll study that in a little while, what the free float market cap method exactly means. Index return is simply the percentage change in the value of the index from one period to another. This essentially also is the price return, that is simply the change in the price of the index. It does not include any dividends paid by the index. So price return will be the change in value. If the index was 100 today, it becomes 101 tomorrow, then the price return is 1%. Total return will be equal to the price return plus any dividends that the index might have paid. Please note that generally for an index, if we are to compute a multi-period return, so let's say we were asked to compute the monthly return, the 1 month return, and we were given 30 daily returns, or let's say there are 22 trading days in a month, so about 22 daily returns were given, and we were asked to compute the monthly return. To compute the monthly return, what would we do? Would we just add these 22 returns? Day 1 plus day 2 plus day 3, so on and so forth? No, this is not what we don't do. So we don't do an arithmetic average, we do a geometric average. That is, we compute the compounded return over the month. So if you had invested $1, then the $1 would become 1 plus R1 after the first day. This entire amount would become into 1 plus R2 after the second day, so on and so forth. So it will be 1 plus the return at the end of day 1 into 1 plus the return at the end of day 2, so on and so forth, into 1 plus the return at the end of the 22nd day minus 1. That will be the monthly return on the index. So RP is the portfolio return during the measurement period. K is the total number of sub periods. So in our case 22 sub periods. RSK is the portfolio return during the sub period K. That is sub period 1, sub period 2, going up to sub period 22. That is 22 daily returns. So for example, the returns in the first two sub periods are 0.5% and 1.04%. What is the total period return if the index value was 100 in the beginning? What is the value after 2 periods? So fairly straightforward. If 100 was the value in the beginning, after the first period the value would become 100 into 1 plus 0.005, that is 0.5%, and after the 2 periods this entire value would again go up by 1.04%, so it would be 1 plus 0.00104. So this will be the value of the index at the end of the periods. Let's use a calculator and solve this. So it would be 100 into 1.005 into 1.00104. that will come out to be 100.6045. We'll store this in the memory register 1. And if you are to calculate the return or the total period return, it can simply be calculated as 100.6042 minus 100 divided by 100. So once again, it will be the value at the end minus the beginning value divided by the beginning value. That is 0.00605 or approximately 0.6%. So the return will approximately be 0.605%. This could also have been calculated as 1 plus 0.005 into 1 plus 0.00104 minus 1. This would also give us the same value of 0.605%. Now, when we construct any index, the Nifty 50, S&P 500 or a sectoral index, there are certain choices that we need to make and certain issues that need to be addressed. So the first question that you have to ask and answer is that what is the target market? Are we making a global index? Are we making an Asia specific index? Are we making an India specific index? Are we making a large cap index or a mid cap index? So on and so forth. If you are making a large cap India index, for instance, then we have to further decide that of all the large cap securities in India, which securities should be included in this index. So if we include all large cap securities, it may be too many to track and monitor or to invest in. If we include too few, then they may not be representative of the large cap performance of Indian stocks. So which of these large cap securities should be included? How should the securities be weighted? Once we have selected the securities, how should we get to the final price, as we discussed earlier? How often should the index be rebalanced? That is, how often should these weights be readjusted? So rebalancing means adjusting the weights of the various securities in the index. When should the selection and weighting of securities be re-examined? So let's say we chose some 50 stocks, and let's say one of these companies becomes bankrupt. So it's no longer a large cap company. So the constituents also may need to be changed and replaced. So there is rebalancing that may need to be done. That is, the weightings of the 50 stocks or any number of stocks may have to be adjusted, and there may be reconstitution that is required. There are some stocks need to be replaced with others as other companies become larger or are becoming more representative of the index that we are trying to create. Now there are various types of indices that can be created. The first one that we'll start with is called a price weighted index. So in a price weighted index, the index value is arrived as a simple arithmetic average of the prices of the securities included. So from this slide onwards, we are just discussing the different weighting mechanisms. That is, we have already selected our securities, the 50 stocks or the 10 stocks, through a qualitative assessment or through the target market that we are trying to address. We have selected the stocks or selected the fixed income securities, whatever it is, and we are now weighting those prices in some manner so as to get to one value of the index. The first weighting mechanism is called the price weighted index, wherein the index value is simply the arithmetic average of the prices of the securities included. Just one point to note, that the divisor in a price weighted index is adjusted for stock splits and changes in composition when securities are added or deleted, such that the index value is unchanged by any such changes. So actual return on the stock will of course affect the index. So if you've constituted the index with 3 stocks whose prices were 10, 20 and 30, then the value of the index to begin with would be 10 plus 20 plus 30 by 3, that is $20. Subsequently, as the prices of these stocks change, the index value will also change. However, the prices can also change because of stock splits, or if one security is removed and another security is added. So such changes are not economic returns. These are just corporate actions, and they don't change shareholder wealth in any manner, or they don't change the return in any manner. So the divisor, that is this number 3, is adjusted such that the value of the index doesn't change because of stock splits or deletions or additions of stocks. We'll study this better with the help of an example. Now, if you want to replicate a price weighted index, replication essentially implies that the performance of our portfolio should be similar to the performance of the index. So if there is an index which is price weighted and consists of 3 securities, and we have, let's say, $100 with us to invest, we want to invest these $100 in such a manner such that the return on our index, or rather the return on our portfolio, is the same as this price weighted index. So if that is the concern, then how should we make our investment? We should buy an equal number of shares in each of the constituent stocks. So if we had $100, or let's assume we had $60, for example, then in our previous example we should put $30 in stock C, $20 in stock B, and $10 in stock A. That is, we should buy 1 share of each stock. Automatically our performance will mimic the index, because as this 30 becomes 35, even in our portfolio 30 will become 35. If this 20 becomes 30, the portfolio also has an equal investment in stock B. So essentially what you will be doing is that you will be investing more money in higher priced stocks, not necessarily bigger companies. These are just stocks that have a higher stock price, wherein you will be investing more of your wealth. Stocks that have a lower stock price, you will be investing less of your money. So it's a slightly counterintuitive approach, because your size of investment is based on the absolute stock price, not on the size of the company or not on the valuation or anything else. Absolute stock price can be very high even if the company is very small, just because the number of shares are lesser. or for any other factor. So it's not a very economic or fundamental approach. However, this is the first weighting scheme that is a price weighted index, wherein the value of the index is simply the arithmetic average of the prices of the securities included. So the price weighted index, once again, is the sum of the stock prices divided by the number of stocks adjusted for splits and any reconstitution of the index. So given the information for the three stocks presented in the following figure, calculate a price weighted index return over a month or over a 1 month period. So the share price as of 1st Jan is given and the share price as of 31st Jan is given, and we are asked to calculate the return over a 1 month period. So the value of the index to begin with would be 60 plus 20 plus 10 divided by 3, that is 90 divided by 3 or $30. This will be the value of the price weighted index. The value at the end of the month would be 20 plus 15 plus 20 divided by 3, that will be 40, and 15, that is 55 divided by 3. So we can calculate 55 divided by 3 as $18.33. We'll store this in the memory register 1. So you see this big $60 has become 20. B also has fallen from 20 to 15. Only C has gone up from 10 to 20. So if you compute the return on the index, it would be the ending value, that is 18.33, minus the beginning value divided by the beginning value. So 18.33 minus 30 divided by 30, that will come out to be minus 38.8%, which is understandable because the biggest stock price has become 1/3. It's fallen by about 67%. So even though a small stock price has doubled, it's not going to impact much because it is the biggest stock price that has the highest weight in this index. At the market close on day 1, stock X has a price of $10, stock Y has a price of $30, and stock Z has a price of $80. If stock Z splits 2 for 1 effective day 2, what is the denominator for the index? So we studied that the value of the index will change as the stock returns changes. However, the value of the index will not change because of splits or because of reconstitution, that is addition or deletion of securities in the index. So let's compute the original price of the index. It would be 10 plus 30 plus 80 divided by 3, that is 120 by 3 or $40. Now if stock Z splits 2 for 1, as we studied in financial reporting and analysis and in other sections also, that a stock split will have no economic significance. It will just double the number of shares and half the stock price per share. So the new stock price from 80 will go down to 40. Market cap won't change. Nothing else will change because the number of shares has doubled. So the new price of the index would otherwise have become 10 plus 30 plus 40 divided by 3. However, we will not divide by 3. The divisor in a price weighted index will change such that this division still remains 40, or the new divisor is going to become 10 plus 30, that is B will become 80 divided by 40, that is 2, such that even after stock set splits, the price weighted index will still be equal to $40, or the value of this index will not change because of a stock split or a reconstitution. The advantage of a price weighted index is that it is simple to compute. It is simply an arithmetic average. The disadvantage, of course, is that the higher priced stock has a higher weight, not necessarily the bigger company or the undervalued company or anything like that. Weight of securities in the index will change because of stock splits. So the value of the index will not change because of a stock split. If 80 becomes 40, then we adjust the index. However, the weight of the stock will now change. Initially, it was about an 80% weight in the index, but now the stock will just be a 40% weight. So the weight in the index will change because of various uneconomic reasons. Some example is the Dow Jones Industrial Average in the US of 30 stocks, the Nikkei Dow in Tokyo of 225 stocks. These indices are calculated and maintained using a price weighting. The more popular index construction methodology is the market cap weighted index. So in this method, the weight of each stock equals the market cap of the index stock as a proportion of the total market cap of all stocks in the index. So the higher market cap will have a higher weight, not the higher stock price. So weight of stock I will be equal to the market cap of stock I divided by the total market cap. So market cap is simply the stock price multiplied by the number of shares. It can also be seen as the market value of the company. So if you want to buy out this company today, theoretically you have to pay the market cap. That is, you have to buy out all shares and you have to pay the particular price per share. So the weight in such an index, the higher market cap, or essentially the bigger company, will have a higher weight. A lot of times the market cap weighted index is calculated as a free float market cap weighted index. That is, when we are doing this market cap calculation, the weighting mechanism remains the same. But when we are doing this market cap calculation, instead of multiplying with total number of shares, we only multiply with the free float number of shares. So the free float market cap will again be the price multiplied by free float number of shares, that is, shares that are available for sale and purchase. That is, it excludes shares that are not available to foreign buyers. It only includes shares that can easily be purchased from the free market. That is, these shares exclude controlling shareholders, that is the promoters of companies who have restrictions on sellings because they have to make disclosures, etc., or who are unlikely to sell, such that illiquid stocks or stocks wherein you cannot easily purchase shares don't have an inordinately high weight in the index, because then it will be difficult to replicate the index because there is not enough shares outstanding or not enough freely traded shares. So hence a lot of times the market cap weighting is retained, however it's a free float market cap rather than the total market cap. To replicate a market cap weighted index, you should invest your money based on the market cap weight of a constituent stock. So if you have $100 and there are 3 stocks One has a market cap of 10%, second has a market cap of 20%, and third has a market cap of 70%. Then put 10% of your money in stock 1, put $20 in stock 2, and put $70 in stock 3. So put your money in proportion of the market cap weights, or in the same proportion as is the market cap of that company relative to the total market cap of the index. Consider the three firms described below. Compare the effects on a price weighted index and a market cap weighted index if stock X doubles in price or if stock Z doubles in price. Assume the period shown in the table is the base period for the market capitalization weighted index and that its base value is 100. So for a market cap weighted index, please remember that we normally reference it to some base value, as I will just explain with an example. So let's do the market cap weighted calculation first. So the market cap of stock X will be the number of shares outstanding. There are 10 shares outstanding multiplied by a price of $1,000. So total market cap of company X is $10,000. Total market cap of company Y is again $10,000. Even though the stock price is $100, there is only 100 shares outstanding. And for company Z, even though the stock price is just $10, my apologies, the first column is number of shares outstanding, the second column is the stock price. So for stock Z, even though the stock price is just $10, there is 2,000 shares outstanding. So again, the capitalization is the highest, that is $20,000, even though the stock price is the lowest. So to begin with, the total market capitalization of this index is 10 plus 10 plus 20, that is $40,000. So the beginning value of a market cap weighted index is $40,000. Now generally speaking, we don't like to represent such a big number, because if we talk about the market cap of world indices, it'll turn out to be in billions of dollars, even trillions at times. So instead of representing such a big number, the first time we do this market cap calculation, we give it some base value. For instance, in this case, we give it a base value of 100. Now this is the stock price at t equal to 0. The stock price at t equal to 1, that is at the end of the period, is if stock X has doubled in price or if stock Z doubles in price. So let's first do if stock X doubles in price, then the price will become $2,000. The other prices remain the same, such that the value or the market capitalization at the end of t equal to 1 will become 20,000 for stock X, 10,000 for stock Y, and 20,000 for stock Z. So the total market cap at t equal to 2, or at the end of the period, will become 20 plus 20 plus 10, that is 50,000. Now again, we will reference this value to the base value of 100. We called 40,000 as 100. So what will we call 50,000? It will be 100 upon 40 into 50, that is 125. So the index would have moved from $100, the market cap weighted index, to $125, or a market cap return in the case of stock X doubling would be 125 minus 100 divided by 100, ending value minus beginning value divided by beginning value, which will come out to be 25%. Now let's see what would have happened in the case of a price weighted index. In the case of a price weighted index, the value at the beginning would have been 1000 plus 100 plus 10 divided by 3. And that is 1110 divided by 3, which is nothing but $370. That is the price at the beginning. The price of a price weighted index at the end would be 2000 plus 100 plus 10 divided by 3. That would come out to be, we can solve 2000 plus 100 plus 10 divided by 3, that is $703. So near about doubling. So the return of a price weighted index would have been 703 minus 370 divided by 370. So we see that a price weighted index has essentially doubled in value, or given near about a 90% return, whereas a market cap weighted index has given just about a 25% return. The answer is, or the difference can be explained because in a price weighted index, it is the highest stock price that has the highest weight. And if this stock price doubles, it will have a big impact. Whereas in a market cap weighted index, it is the highest market cap that has the highest weight. So stock Z hasn't changed. Even if stock X doubles, it will only have a 25% impact on the overall index returns, because the weight of stock X is only 25%, that is 10 upon 40. Similarly, you can please verify yourself that if stock Z doubles in price, that is from 10, stock Z becomes 20. On a price weighted index, it will have a marginal impact. Rather, it will have no impact at all, because it's a very low weight in a price weighted index. However, in a market cap weighted index, it will have a significant impact because it is the highest weight in a market cap weighted index. So again, you can verify the calculations from stock Z so as to understand the difference between the two weighting methodologies. The advantage of a market cap weighted index is that larger securities have higher weights in the index. But this is also the disadvantage. So although it is intuitive that bigger companies should have bigger weight because it will be easier to invest in them, and they will be more representative of the economy because they are big companies, so they'll have presence across the country or across the world. But this is also a disadvantage because a large market cap may be large because it is potentially overvalued. So if you are replicating this index, then you're investing more in larger companies and you're investing more in potentially overvalued securities. So undervalued securities will have a lower weight potentially, and potentially overvalued securities may have a higher weight. Many examples exist. S&P 500 is a market cap weighted index. Nifty 50, BSE 30 are all market cap based indices in India. They're both free float market cap based indices. That is, it's not the total market cap, it is the free float market cap that is taken, as we discussed earlier. The last weighting mechanism that we will study is referred to as an equally weighted index. So in an equally weighted index, the return on the index is calculated as the arithmetic average of the return on the individual stocks. So the weight of all stocks is the same. It doesn't matter what the stock price is, it doesn't matter what the market cap is, the weight of all stocks is same. Whatever return all stocks has given or have given will be averaged, and that average will be the return on the index. So if there are 3 stocks, whatever be the stock price, stock 1 gives a 10% return, stock 2 gives a 0% return, stock 3 gives a 5% return, then the return on the index will be calculated as 15 by 3, that is 5%. So if index value was 100 in the beginning, it will become 105 at the end. Next period again the same thing will be done. The weight of all stocks is the same. So the return of each of these stocks will be seen and averaged, and the return on the index will be the average return of the constituent stocks. So if you have $100 to begin with and you want to replicate the performance of an equally weighted index, then you should simply invest equal dollar amounts in each index stocks. So in stock 1 invest $33.33, in stock 2 likewise invest 33.33, because all stocks have the same weight. So if you want your performance to mirror that of this equally weighted index, then you should invest equal amount of money in each stock. The value line composite average, Financial Times ordinary share index are some examples of an equally weighted index in the real world. So calculate the equal weighted index value for the 3 stocks described below, assuming an initial index value of $120. So to begin with, the index value is $120. The 3 stocks are given, the initial price is given, and the current price is given. We are asked to compute the index value at the end of the period. So let's first calculate the return of each of these individual stocks. So for stock X, the return would be the ending value minus the beginning value divided by the initial price of the beginning value. So it will come out to be 100%. For stock Y, it will be 45 minus 25 divided by 25, which will come out to be about 80%, that is 20 divided by 25. For stock Z, the return would be ending value minus beginning value divided by the beginning value, that is 10 upon 40, approximately equal to, rather exactly equal to minus 25%. The return on the index will be the arithmetic average, that is 100 plus 80 minus 25 divided by 3. So this will be the return on the index, which will be calculated as 100 plus 80 minus 25 divided by 3, that is 51.66%. So if the initial value of the index was 120, then the value at the end would become 120 into 1 plus 0.51667, which can be calculated as $182 approximately, or rather 182 would be the index value at the end of the period. So this is an equally weighted index. Regardless of the price or the market cap, all 3 stocks have the same say. So whatever return each stock has given would be multiplied by 1/3 and would be a part of the index's return. To replicate, invest equal amount in each stock that is a part of the index. The advantage again is that it is simple to compute, doesn't have the biases of a large cap index or a price weighted index. The disadvantage is that it will require frequent rebalancing. So let's say we invested our money in stock XYZ in the previous example, and let's say all stocks were $10 is what we invested. At the end of the period, this $10 would become 20, this 10 may have remained flat, this Z may have fallen by 50%, may have become 5. So in the next period, even though the index will remain equally balanced or equally weighted, our portfolio will be weighted more towards the stock that has done well. So we will have to rebalance, that is, we will have to sell stock X and put some money in stock Y and stock Z so as to keep the portfolio equally balanced at all points in time. So after every period, we'll have to sell the stock that has outperformed and buy the stock that has underperformed to keep it equally balanced if we were to replicate this index. With the market cap weighted index or a price weighted index, this wasn't a problem, because if one stock did well, its market cap would also increase, so its weight in the index would also increase. If a stock did well, its price would also increase, hence its weight in the price weighted index would also increase. So the rebalancing wasn't needed in a price weighting index or a market cap weighted index. In an equally weighted index, however, the weighting remains the same. So I will have to rebalance our portfolio so as to have equal amount of money in each stock at the end of each period. So that's about the 3 popular weighting mechanisms. Other weighting mechanisms also exist. We won't do a numerical example, but we will understand the other weighting mechanisms. So in fundamental weighting, the weights are not based on market cap or price, but rather on firm fundamentals. So earnings growth or the PE ratio or the dividend yield or the free cash flow yield, etc. are the weighting factors. So firms with low P by E, for instance, will have a high weight in the index. The firms with high P by E will have a low weight in the index. So a method like this would avoid the bias in market cap weighted indices. That is, the overvaluation bias that we studied would be avoided if we base the weightings on price to earnings multiple or some fundamental factor rather than the market cap or the stock price. Once again, a rebalancing is the process of adjusting the weights of the securities to their target weights after price changes have affected the weights. So for example, in an equally weighted index, we studied that as price changes, the weighting may change. So we may have to again adjust or rebalance the portfolio so as to bring it back to the target weights. Reconstitution is the activity of periodically adding and deleting securities that make up the index. We had a brief discussion on this also in the beginning of the review, that certain securities may come up, certain securities may need to be removed. Indices have various uses. They can be used as a reflection of market sentiment. They can be used to benchmark a fund manager's performance. A lot of times we talk about market return and market risk. We'll do that a lot in portfolio management. So market return and market risk is nothing but the return on the index and the risk of the index many a times. The index can be used to measure the beta of the market and to measure risk adjusted return of a portfolio against the market. So again, basically the index can be used as a representation of the market, and it can be used as a model portfolio for index funds. Index funds are funds that don't do active management. They simply replicate whatever is the benchmark or whatever is the index. So these are some uses. Now there can be various classification made of equity indices. So broad market equity indexes represent the majority of stocks in a market. So these will generally have a high number of securities, and they represent the performance of the equity asset class or the broad market. So CNX 500 will have 500 stocks in the Indian markets. Similarly, other stocks with 1000 securities, 2000 securities, or 500 securities are referred to as broad market indices. Multi-market equity indexes contain the indexes of several countries. So multi-market indices with fundamental weighting use market capitalization weighting for securities within a country's market, but then weight the countries within the global index by a fundamental factor. So this is one popular method of creating these indices. So let's say there were 3 countries, A, B and C. Within the country, a market cap weighted index is applied. So within the country B, to select the stocks, a market cap weighted index is used. However, to weight the 3 countries, we use a price to earnings multiple or a free cash flow yield or some fundamental factor rather than simply the market cap of the countries as a whole. So within the countries, it's a market cap weighting that is done, but to weight each of the countries in the index, we use a fundamental factor. Sector indexes measure the returns for a sector. And can be used as the model portfolios for sector specific funds that are launched from time to time. Similarly, style indexes measure the returns to a particular style. So that style could be a value style, which invests in low price to book, low price to earnings, high dividend yield stocks, or it could be a growth style that invests in higher growth stocks. Style could also be based on market capitalization. So a large cap style, a mid cap investment style, a small cap or micro cap style, or some classifications. Stocks may tend to migrate, that is, a small cap stock may become mid cap or a mid cap may become large cap, which will cause style indexes to have higher reconstitution than broad market indices. Indices can similarly also be constituted and constructed for fixed income markets. However, there are some issues with fixed income indexes that we should be aware of. First of all, the universe of securities is much larger than equities, wherein there may be only 500 or 1000 large liquid names in a country. The number of fixed income issuances may be much higher, because for every corporate A, there will be only one equity. There will be one type of equity share, or maybe 2 types of equity shares at the most, but for the most part, they will just have a common equity listed. But on the fixed income side, they may have many different bonds of differing coupons, differing maturities that may be issued by the same company. Hence, the universe becomes much larger. And governments don't issue equity, but governments also issue bonds. So there are different types of bonds, different maturities, etc. Hence, the constitution and the calculation becomes more complicated. Fixed income markets are generally dealer markets, and the trading is not as frequent as in equities. So these markets are typically illiquid. Hence, a lot of times the value of a lot of securities may need to be estimated from the traded values of similar securities because of the illiquid and the unreliable markets. So once we've addressed these issues, the indices can again be constructed based on a particular issuer, that is a particular credit quality. So an index of AAA rated bonds, a broad fixed income market index. Again, index can be made for a particular coupon rate or for a particular maturity, so on and so forth. So after that, construction mechanism may be similar. However, these issues need to be addressed and you need to be aware of. A commodities index would likewise represent the performance of a commodity basket. So wherein again, some issues to consider is the weighting method. Some indices use the global production to weight the different commodities. So commodities include gold, agricultural commodities, livestock, energy, oil, etc. So which commodity to weight how much is the question. So some indices use global production. So commodities that have higher production will have higher weight, and that have lower production will have lower weight in the index. Sometimes we use an equal weighting, etc. A lot of trading in commodities happens using the futures market rather than spot market. So a lot of the trade, a big portion of the total trade happens in futures as compared to equities in the case of commodities. So hence the commodity indices will normally use commodity futures prices, and the returns hence may differ slightly from the actual spot price changes of commodities. A real estate index will be representative of the performance of real estate, wherein again data is tough to find. So a lot of times the real estate values are based on appraisal. That is, again, it is an estimation or from similar properties or comparable sales. So it's not actual data. Repeat sales data is waited for us to change the value of the index. So again, the return on the index may not be very representative and maybe with a lag, etc. Real estate investment trusts, which are listed entities, can also be used to represent the performance of real estate or to construct a real estate index. Hedge fund indexes represent the performance of hedge funds on the whole. So normally an equally weighted methodology is used. So we basically just take an average of the returns of all hedge funds to give the return of the hedge fund index. So hedge funds are normally unregulated, hence data is again difficult to find, and reporting also has various biases that we'll study in other reviews. So that was about the review on security market indices. Some examples are presented of the various indices with what kind of number of securities, the weighting method, etc. that they use. Don't have to remember these for the exam, but you still can go through so that you know the large indices in the world, what kind of methodologies they apply to weight securities and to calculate returns. So that's about the review on security market indices. Thanks a lot, and see you next time.